You have shown us the life cycle of an instrument for long-term investment. Can that same cycle be applied to shorter plays? If so, frames would work best while using the 20 period and 200 period simple moving averages. Now, what Alexandra is actually speaking about, traders, is she's talking about the fact that I teach traders that all markets are practically trapped on rails. All right. They literally have to follow one path. And that repetitive path is called the boom to bust cycle. This path or this cycle never changes. It's not like markets have four cycles to choose from. It's not like they have a variety of choices. All markets follow one cycle over and over and over again. Now, let me see if I can demonstrate this for you a little bit. Every every market must follow that cycle and repeat. And all markets are is just this repetitive cycle over and over and over again. Now, what makes it tricky, what makes it not so obvious, right, is that sometimes the cycle is like this. That's the same cycle. It's just that the left leg is longer than the right leg. And sometimes the cycle is like this. Sometimes the left leg is shorter than the right one. So sometimes left and right are equal. Sometimes left is lower, right is higher. Sometimes right is higher and left is lower. Right? So that's one of the things that makes excuse me, one of the things that makes the cycle somewhat difficult to ascertain for people who don't understand. All right? So another thing that makes the cycles somewhat difficult is that the top of the cycle and the bottom of the cycle are sometimes pointy. You see that? That's a pointy top versus a rounded top, a pointy bottom versus a rounded bottom, a pointy top versus a rounded top. You see what I'm saying? And so it's the different tops and bottoms, the different shapes of the tops and bottoms, and the different lengths of the left leg versus the right leg that can throw a trader unless they're trained to identify the cycle. So if we look at this is a weekly chart of Apple. Now look at the cycles. Here's your left leg, here's your top, here's your right leg, and boom. All right? And so in this case, your cycle is like that. Okay? And we get another cycle. And another. And so there are these micro cycles. All this movement is a variety of cycles repeating themselves. Here's one. Here's another. You see? Here's another. And then look, here's a tiny one. Here's one of your equal ones right there. Boom. And here's another. Now, the key to playing this properly is to know where you are in the stocks or the item's current cycle. You understand? So you should know, have I been in an upward movement for quite some time, which would suggest that you're probably closer to the end of the upward cycle than you are to the beginning of it or the middle of it. Okay? And am I at the cycle here? Right? Is that where I am in the overall cycle? Because if you're here and you're looking for a lot more downside, then you don't understand cycle analysis. All right? Because you're looking for massive downside at this part of the cycle, but not after a drop like this. You would be looking for minimum downside with more potential upside. All right. So that's what Alexandra's talking about cycle. I teach my traders how to read the markets from a cyclical point of view. Now, she's asking, is this theory or approach to reading markets applicable in smaller time frames? Of course they are. So my traders trade predominantly from a 2-minute chart. And if we take a 2-minute chart scenario, you see the same cycles. Now, of course, Apple's been on, look at this cycle. Boom, cycle complete. It's a shorter one. Now look at this one. Cycle complete. Well, cycle complete. So in this one, you have the left leg or the right leg is now longer. And so these are more micro cycles. All right. Of course, when you're in a bear market, your down legs are longer than your up legs. So in a downward market, the up legs are small, the down legs are big. In a bull market, the down legs are small and the up legs are big. Up leg big, down leg small. In a downward market, up leg small, down leg big. So look at your down legs. Here's your up and here's your down. Here's your up and here's your down. The up legs are smaller than your down legs. Proper trading, right, starts from cycle analysis. How can you come up with the right side of the market and the right strategy that fits that right side? How can you get that right if you don't first answer the question, where am I in the stock's current cycle? If you don't know where you are in the cycle, you're playing a guessing game as to what's the highest probability of an up move versus a down move. All right. And so you have to know cycle analysis. Every intelligent action must start from the knowledge of knowing where you are in the stock's cycle. So I hope that makes sense. So yes, cycle analysis is applicable whether you are playing the markets from a macro perspective, all right, meaning holding things for many years, all the way to a micro cycle, trading a 2-minute chart. All right. Cycles are not dependent on time. There is only one atom that makes up the entire market, irrespective of time, and that is that bell-shaped curve. All right. Now, there's a lot more to learn about cycles, like how to divide each cycle up into its 7 different parts. All right. Each cycle has 7 different parts, and I drill down to teach traders how to actually play and what to expect in each one of the 7 parts of an individual cycle. Very powerful stuff. All right. That cycle knowledge alone places you head and shoulders above the vast majority of people out there who have no clue of how to determine where they are in the cycle.